All right, so get this. You sent us some training videos, and they're in Thai
Wow.
with English subtitles about a system. It's called ThaiQuants.
Okay.
I know. It sounds a little niche, right?
Yeah.
But trust me on this one. This deep dive into advanced market classification techniques, I think this is going to blow your mind,
Right.
no matter what markets you trade.
Okay.
We're talking about building better trading signals.
Okay.
And this ThaiQuants approach has some seriously clever twists.
I like it.
So, how do we even start to unpack this?
Yeah, well, it's all about making our trading smarter, not harder, right?
Right.
These videos, they focus on classifying market conditions to sort of fine-tune entry and exit points.
Okay, so let's decode this a little bit. They use the Hasteit Index, which is Thailand's main stock market, and the NCD indicator as examples.
Right.
But I'm curious, what makes the ThaiQuants use of the MCD different from how most traders use it? It seems like they're digging way deeper.
Yeah, you're right. They're not just looking at like basic crossovers, right?
Right.
ThaiQuants actually integrates the MCD into a concept they call momentum decay,
Okay.
which helps determine when a trend is losing steam.
Mm-hmm.
So you're adding another layer of analysis, and that helps traders avoid those frustrating trades that fizzle out way too soon.
Interesting. So they're combining market classification with this idea of momentum decay to really sharpen those signals.
Exactly.
The videos also go deep on how they actually code these buy and sell conditions. I was struck by how specific they are about using logical operators like and, or.
Yeah, that's a key takeaway here.
Okay.
They don't just rely on one indicator or price pattern. They combine multiple conditions.
Right.
And they're making sure a trade is only triggered when all the criteria are met.
Right.
This helps weed out those false signals.
Yeah.
And it improves the odds of catching those high probability moves.
And speaking of testing the odds, they actually backtest 4 different scenarios in AmiBroker.
Yeah.
No classification. Only buy signals classified, only sell signals classified, and both buy and sell signals classified. So I'm guessing this is where things start to get really interesting.
Absolutely. By comparing those scenarios, they're demonstrating just how much impact market classification has on performance.
Right.
It's like running a controlled experiment to isolate the variable of market classification and really prove its value.
I love that they don't just tell you it works. They show you the data.
Exactly.
Yeah.
Show me the money.
Right. And then they go even further with something called sensitivity analysis, which they dedicate a whole section to.
Yep.
To be honest, I've heard that term thrown around, but never fully grasped its importance.
Yeah, it's like fine-tuning a musical instrument.
Okay.
Sensitivity analysis helps you understand which components of your trading signal have the biggest impact on your results.
Yeah.
By systematically tweaking different parts of your strategy.
Right.
You can identify the crucial elements and eliminate anything that's adding noise or hurting performance.
So it's like finding the signal through the noise.
Yeah, exactly.
But here's what I found really clever. They use the optimization feature of AmiBroker to automate this whole process. And get this, the goal isn't actually to optimize the strategy for maximum profit, which is what I initially assumed.
Yeah.
It's a brilliant approach.
Yeah.
It might seem counterintuitive at first, but by automating the sensitivity analysis, they're able to test a huge number of variations, gaining a much deeper understanding of how each component interacts with the others and impacts the overall results.
It's like they're running a massive simulation to uncover the hidden dynamics within their strategy.
Exactly.
That makes so much sense. And they don't stop there.
Right.
They even show you how to chart these results in Excel, focusing on specific performance metrics.
Yeah.
This is where the visual element comes in, right?
Yeah.
Absolutely. They focus on metrics like annualized return, percent win rate, maximum drawdown, and a less common metric called the system quality number, or SQN.
Okay.
Visualizing this data in charts helps you quickly grasp the impact of different variations on your overall trading results.
It's like seeing the whole picture come together, connecting the dots between each element of the strategy and its impact on performance. This is really powerful stuff. Okay, before we get too far ahead of ourselves, I want to make sure we're crystal clear on what we've learned so far.
Sure.
I think there are some really big concepts that we've already touched on.
Absolutely. We've seen that ThaiQuants utilizes market classification to really fine-tune those trading signals.
Right.
They don't just use it in a general sense. They combine it with this idea of momentum decay, which gives traders a deeper understanding of when a trend is likely to run out of steam.
Okay.
And then, of course, they've highlighted the importance of robust testing, using back testing and sensitivity analysis to develop a strategy that's resilient in different market conditions.
So it's not just about finding a strategy that works in theory, it's about building a system that can stand up to the real-world challenges of the market. I'm already starting to rethink my own approach to signal development.
And what's really fascinating is how they tie those concepts into specific trading setups.
Yeah.
The ThaiQuants system, it centers around identifying breakouts above the 200-day high.
Okay.
But they go beyond just that simple price action.
So it's not just about chasing any stock that pops above that level.
Right.
There's more nuance to their approach.
Exactly. They emphasize understanding why a breakout strategy works in the first place.
Right.
They're looking for stocks that are exhibiting strong upward momentum, where buyers are clearly in control. But they also caution against blindly buying every breakout.
That makes sense. I've definitely fallen into that trap before, chasing breakouts that quickly fizzled out.
Right.
What's their secret to filtering out those false signals?
They look for specific characteristics that tend to precede successful breakouts. Almost like they're looking for clues in a detective novel. For example, they analyze the behavior of moving averages.
Okay.
Leading up to the breakout.
Right.
Are they converging? Suggesting a tightening of price action?
Okay.
Or are they fanning out?
Right.
Indicating indecision.
So it's like they're looking for those telltale signs that the market is about to make a decisive move.
Exactly.
They're not just reacting to the breakout itself.
Right.
They're anticipating it based on the patterns that come before.
Precisely.
Yeah.
They also examine the width of the Bollinger Bands.
Okay.
Looking for periods of compressed volatility. This often foreshadows an explosive move as the price breaks out of that tight range.
It's like the market is coiling up like a spring, storing energy before it releases.
Exactly.
This is really making me think about how I can apply these concepts to my own analysis.
And they don't stop there.
Okay.
They also analyze the price action after a breakout.
Right.
Watching for signs of momentum decay.
So they're not just assuming that a breakout will continue indefinitely.
Right.
They're monitoring it closely to see if it's losing steam.
Absolutely. They even introduced the average directional index, or ADX, to measure the strength of the trend.
Right.
If the ADX is weakening after a breakout, it's a warning sign that the move might be losing momentum.
That's a really clever way to protect profits and avoid giving back gains.
Yeah.
It's like they're paying close attention to the market's body language, looking for those subtle shifts that indicate a change in sentiment.
And what I appreciate is that they emphasize visually inspecting price charts to confirm the patterns they're seeing in the indicators. They're not just relying on numbers.
Yeah.
They're using their eyes to understand the story the market is telling.
It's like they're reading the market's mind, not just crunching numbers.
Exactly.
Speaking of visual patterns, they highlight one they call a momentum coil. What exactly does that look like on a chart?
It's essentially a period of consolidation before a breakout.
Okay.
Characterized by narrowing price ranges and decreasing volatility. Imagine a spring being compressed, storing potential energy for an eventual release.
So it's like the market is taking a deep breath before making a big move.
Exactly.
And they use this momentum coil pattern to gauge the potential strength of a breakout.
Exactly. They've observed that breakouts from tight momentum coils often lead to more powerful and sustained moves.
It's like they're looking for those stocks that are primed for a big rally.
Right.
But they also make a point of emphasizing that the placement of the momentum coil within the broader market trend is crucial.
Right. A momentum coil forming during an uptrend is more likely to signal a continuation of that trend. But if it forms during a downtrend, it might just be a short-lived bounce or even a trap.
So it's all about context.
Exactly.
You need to understand the bigger picture to interpret these patterns correctly. I'm starting to see how this whole system fits together. They're not just throwing out random indicators.
Right.
They're weaving them into a coherent framework for analyzing the market.
And that's what makes the ThaiQuants approach so compelling.
Right.
It's a systematic way to identify high-probability setups and manage risk. But they don't stop at just breakouts.
Okay.
They also explore alternative market classification approaches.
All right.
One of them is based on the volatility index, or VIX.
The fear index.
Yes.
That's a fascinating one. Can you explain how they use it for market classification?
They divide the market into 3 regimes based on the level of the VIX.
Okay.
Low volatility, medium volatility, and high volatility.
Okay.
Then they adjust their trading strategy accordingly.
Right.
For instance, in low volatility environments, they might widen their profit targets.
Okay.
While in high volatility conditions,
right,
they might tighten their stops to protect capital.
It's like having different game plans for different opponents. You wouldn't play the same way against a team known for aggressive offense as you would against a team known for their defense.
Exactly. It's all about adapting to the prevailing market conditions to maximize your chances of success.
All right.
And they don't stop at the VIX.
Okay.
They also explore using a trend filter for market classification.
I've heard of trend filters, but never really understood how they work.
Sure.
Can you shed some light on that?
A trend filter is essentially a way to smooth out price data.
Okay.
And identify the underlying direction of the trend. It's like removing the static from a radio signal.
Right.
So you can hear the music more clearly.
So it helps you cut through the noise of the market and see the true direction of the trend.
Exactly. They specifically use the Guppy Multiple Moving Average, or GMMA, which incorporates both short-term and long-term moving averages to provide a comprehensive view of the trend.
It's like having a team of scouts reporting back on the market's movements, giving you a multidimensional perspective.
Exactly.
And how do they actually use the GMMA for market classification?
They look at the relationship between the short-term and long-term moving averages.
Okay.
If the short-term averages are above the long-term averages, it suggests an uptrend. Conversely, if the short-term averages are below, it indicates a downtrend.
It's like watching a flock of birds. If they're all flying in the same direction, you can get a sense of where the wind is blowing.
Precisely. And just like with the VIX-Based Classification, they adapt their trading strategy to align with the trend identified by the GMMA. This is where things get really interesting. Because they start to combine these different classification techniques, looking for confirmation signals.
So they're not just relying on one method in isolation. They're looking for convergence between different indicators to increase their confidence.
Exactly. For example, they might look for a momentum coil forming near the 200-day high during a period of low volatility, as indicated by the VIX, while the GMMA confirms an uptrend.
Wow. So they're stacking the odds in their favor by looking for alignment between multiple factors.
Exactly.
It's like a symphony of indicators all pointing in the same direction.
It is.
This is making me realize that market classification is much more than just a simple technique. It's a whole framework for understanding the market and making smarter trading decisions. But I'm curious, do they ever encounter situations where these different classification methods disagree?
Absolutely. And that's where experience and judgment come into play. They emphasize that no system is perfect, and there will always be situations where the market throws you a curveball.
So it's not about blindly following the signals. It's about using these techniques as tools to inform your decisions.
Exactly. They encourage traders to develop their own intuition and risk management skills to navigate those tricky situations where the indicators might be giving conflicting signals.
This is all incredibly insightful. I'm starting to see how powerful these techniques can be when used correctly. It sounds like they're really emphasizing the importance of having a flexible mindset and not being afraid to adapt to changing market conditions.
Absolutely. They even suggest experimenting with other classification methods beyond what they cover in the videos.
Now that you mention it, they do briefly touch on the idea of classifying the market based on seasonality. I've always been intrigued by that concept. Have you ever explored that in your own trading?
Yes, absolutely. There's a well-known saying in the markets, sell in May and go away. It refers to the historical tendency for stocks to perform poorly during the summer months. There's actually quite a bit of data to support this seasonal pattern.
It's amazing how these patterns repeat themselves over time. It's like the market has its own internal rhythm.
And you can even go deeper than just monthly seasonality. You can look at specific days of the week, for example. Some traders believe that Mondays tend to be bearish, while Fridays tend to be bullish.
So it's like the market has its own personality quirks. I'm starting to see how understanding these nuances can give you an edge.
Precisely. And the beauty of market classification is that it's not limited to just price and volume data. You can incorporate other factors like economic indicators, sentiment data, or even news events.
It's like you're building a multi-dimensional map of the market, using all these different layers of information to get a clearer picture.
And the more data you can integrate, the more robust your classification system becomes.
This is really eye-opening stuff. I feel like we've only scratched the surface of what's possible with market classification.
We really have. But I think the most important takeaway for our listeners is that this isn't just some theoretical concept.
Right.
It's a practical tool that can be applied to any trading style or market.
It's about empowering yourself to make more informed decisions, not just blindly following the herd.
Exactly. And it all starts with that curiosity, that willingness to explore new ideas and challenge conventional wisdom.
That's what I love about these deep dives. It's about pushing the boundaries of our knowledge and expanding our trading horizons.
And who knows what discoveries await. The market is constantly evolving, so there's always something new to learn.
This has been an incredible journey through the world of market classification. I want to thank you for sharing your insights and expertise with our listeners today.
It's been my pleasure. I always enjoy exploring these fascinating topics with you.
And to our listener, we hope this deep dive has sparked your curiosity and inspired you to take your trading to the next level. Remember, the key is to experiment, adapt, and never stop learning.
Well said. Until next time, happy trading.